And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And of course, it is Thursday. It is actually the best day of the week, usually the second best day, but today is the last day of the week. It's also options expiration day, so we'll have about $2.8 trillion worth of options expiring today. So that's going to probably lead to some market volatility. Of course, we're right in the midst of now earnings season, really kind of getting on, kind of going forward. So we're going to see some volatility in stocks that are reporting earnings. It's going to be an interesting morning kind of right out of the gate because of healthcare in particular. UnitedHealthCare shares are down about 17% this morning, but Eli Lilly is up about 11% this morning. So just two divergent stocks within the markets this morning, but UNH is in the Dow, so that's going to drag down the Dow this morning. But Eli Lilly announced this morning, so, one of the big rages over the last, year and what's been driving these healthcare stocks like Eli Lilly and Novo Nordisk and others has been this GLP-1 weight loss drug, right, which is an injectable. You've seen all the commercials for it on television, of course, and this has been leading to a lot of weight loss. A lot of celebrities have lost a lot of weight, right? Because of GLP-1. So it works well, but it's an injectable. And so one of the things that these companies have been trying to do is move this into pill form, so you can just take a pill to lose weight. I mean, this is, who wants to exercise and diet when you can just take a pill and lose weight? Well, the trick with the drug is that it makes you not want to eat. It just makes you not hungry, so you don't want to eat at all. Which is why you lose weight. So, they figured out a way. They can't fit, they haven't figured out how to get the exercise in a pill yet. So we'll have a lot of skinny fat people, but, they'll just be like skinny marshmallows. They'll have no muscle tone, but they'll be skinny, right? But anyway, Eli Lilly this morning announcing that in their trials that the pill version of the GLP-1 has the same weight loss effect as the injectable. So on that news this morning, that stock's going to be trading up very sharply. But hey, good news. They've now figured out how to put weight loss in a pill. So now if they can just put wealth in a pill, now we're talking. So, or good looks in a pill. We'll get it. They're going to figure it out, right? They're going to get it all in a pill eventually. So. Anyway, so yesterday, of course, the big news, and we'll get into this with Michael Leibowitz this morning, was the Jerome Powell speech, which sent the market a-tumbling yesterday. He came out and basically said that inflation from the tariffs may persist for a bit of time here. And but he said at the same time, everything's fine. I don't need to cut rates. We'll get into more of that detail with Michael Leibowitz this morning about what he actually said and the impact on the markets. But it did cause the markets to sell off a good bit yesterday. They did recover towards the end of the day. We're starting to see institutional buying coming back into the markets here, and that's a good sign, particularly after we've had this recent decline. We're starting to see buyers kind of come back into the markets at these lower levels. So, that's been helping, been very, very supportive. But again, this has now re-sparked that feud between President Trump and Jerome Powell. And President Trump tweeting out yesterday after Jerome Powell's speech that his termination cannot come fast enough. So we'll see how where the gauntlet has been thrown down on this front. So it is now done. But we'll see how this works out. But of course, Jerome Powell's concern is, of course, that tariffs will cause higher prices. But again, when you get back to the very basics of this, two things are happening right now. First of all, the White House has been meeting, for instance, with Japan to negotiate trade deals that's going to remove tariffs potentially with Japan. So while there's concern from the Fed and everybody's looking at tariffs across the board, these negotiations are going to remove tariffs, which are going to remove that threat of tariff inflation. But the other side is also consumer choice. As we've talked about before, consumers are simply getting to the point that they're running fairly lean. We're seeing delinquencies rise, defaults rise. We've talked about on the show before. We're seeing spending slow down. Retail sales report was good. A lot of people pointed to the fact that that was pre-tariff buying. Consumers really don't work that way. They don't run out and just buy a bunch of stuff because of a threat of a tariff. They're just trying to make ends meet. It was spring break in March. So you typically have fairly strong retail sales in March, and core retail sales were strong, even outside of autos. So you have spending that goes into March because of spring break, and so you typically get a little bit stronger retail sales number in March, which is what happened. You're going to have strong retail sales in April because of Easter, and well, then what are we going to say now? Oh, we had strong retail sales in April because of tariffs? I mean, and this is the point, is that, we're trying to assign narratives to a lot of things. Gold went up, had a big move yesterday on tariffs. We're trying to assign all these narratives to, this tariffs are causing this, tariffs are causing that. We really don't know what tariffs are doing at all at this point. It's a lot of assumptions. And we're trying to apply tariff narrative to everything that goes on in the markets. And that's not really, kind of what drives markets ultimately at the end of the day. It's a lot of speculation in some assets, and other assets, it's concerns, kind of both ways. So you've got all this stuff that's going on within markets that really has much less to do with narratives than it does just the internal workings of the market. So always try to step back and say, what's really driving markets here? Is it this narrative? Is it that narrative? Because if next month, after we've had tariffs, if retail sales are super strong for some reason, I'm just saying, then what happens to the tariff narrative? Tariffs are causing people to buy more stuff now because they're more expensive. So narratives are going to change for whatever it is. And then when some asset doesn't work anymore that was working, or some asset starts working that wasn't working before, then the narrative will change, and then we'll apply a new narrative to that. So just be careful with narratives. Okay, very quickly, here's what you need to know before the bell. Markets have been, basically trying to recover from this recent low. We're on a very short-term buy signal. Markets are not really overbought here yet. So again, we can certainly see a bit more consolidation through this period right here. And again, I would not doubt that to any great degree, particularly with this crossover between the 50 and the 200-day. You want to be careful here. A lot of headlines. This is in today's daily market commentary. I have a chart and some analysis going back on these 50, 200-day moving average crossovers. The majority of the time, outside of a recessionary event-driven markets, 50-day crossovers below the 200-day, the dreaded death cross, are typically more commonly associated with market lows than they are the beginning of a corrective cycle. So again, you go back and look at the Euro crisis, the Brexit, you take a look at the end of QE1, the end of QE2, all those things. There were very short downturns of the markets below when that 50 and 200-day moving average crossed over, and then markets began to rebound, and then the 50 to 200-day crossed back up again. So unless there is a recession or some credit-related event within the markets, these tend to be fairly short-lived, generally 3 to 4 months. And then they begin to recover and begin to move higher, and those crossovers reverse in direction. Again, just kind of watch this. But it does provide overhead resistance. It does suggest that markets will remain consolidating here for a bit longer. We're not going to go running back off to new highs anytime soon. But it also suggests right now that we're probably at least, considering the extreme negativity that we're seeing in the markets in terms of sentiment, positioning, etc., that we may be more in the process of creating a low in the market rather than the beginning of a longer-term downturn in the markets. Now, again, that can change, and if it does, we'll certainly adjust as we go. But again, we want to look at the data and pay attention to positioning and understand what the risk is here in the markets currently. But don't get too tied up with these crossovers. They tend not to be as bearish as a lot of the headlines want to make you lead, or will at least lead you to believe. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Liebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. It is, of course, Thursday, day before Good Friday. Michael Leibowitz joining me this morning. Got a lot to get into yesterday. Had the big throwdown start yesterday between President Trump and Jerome Powell after Jerome Powell's comments about tariffs, inflation, and, of course, why we give so much kind of credit, I guess, to Jerome Powell is kind of beyond me because he's generally wrong more than he's right. But, it is the way the markets work right now. So let me just throw it to Mike real quick and just get his initial take on what he thought about Powell's comments yesterday.
Yeah, I thought both his comments were stunning and then Trump's rebuttal. I guess nothing from Trump's stunning anymore, but it was also a little bit shocking. Powell was very hawkish. He said that the tariffs caught them off guard, that they were much larger than expected. He didn't really acknowledge the fact that in all likelihood, they're going to be negotiated much lower and probably closer to expectations. Lance, you mentioned earlier, I think the word that kind of rattled the market was persistent. He said that some of these tariffs could lead to persistent inflation. And while it rattled the stock market, the bond market rallied. The bond market is predicated on inflation. Inflation drives the bond market. Bond market didn't have any problem with the word persistent. Stock market did. And then there was another one, I think, that may have really upset the market. Someone asked him, this was at, I believe it was the Economic Club of Chicago, and one of the, someone attending the speech asked him if the Fed would rescue markets if need be. And he said, the market's functioning as it should. There's no need for us to do anything. That also is very questionable. Right. Last week, we talked about basis trades. You did a great special video on basis trades. We've written a few articles. My last article was in part on basis trades. There's a liquidity problem. And it sounds like Powell's trying to ignore it publicly, privately, he is spending all his time dealing with this liquidity problem. There, he is taking phone calls from banks, from Wall Street, and trying to figure out how to get around it. And, publicly, he's saying very little. So some very interesting and a couple odd comments from Powell. And then obviously Trump came out this morning saying, and it's unclear exactly what he meant, but something to the effect that that Powell's termination can't come soon enough. Now, whether he's referring to Trump firing Powell, which is a big legal issue, or whether it's referring to the end of his term, which is in about a year, is unclear. But kind of knowing that Trump is the guy that fires people, I'd probably bet that he may try to do it sooner rather than waiting for the end of his term.
Well, yeah, and again, this is going to be the big debate, right? We went through this back in 2018, and this is very much the kind of the throwback to the whole 2018 throwdown between President Trump and Jerome Powell. And of course, there was a lot of, articles being written at the time. But does the president really have the authority to fire him? Can he fire him? And again, I'm sure we're about to get back into that. That whole debate again right now, because again, I thought it was interesting because, if the president could just come out and fire Jerome Powell immediately, kind of, right off the cuff, he'd do it yesterday, right? It's just I can't wait for his termination. If you can fire him, fire him. So this is going to be the big internal debate, I think, in the media is going to be how much authority does he have? Can this actually get done? And then, of course, really, who's the replacement going to be to find somebody that's more friendly other than Jerome Powell? Who would, I don't know who he'd try to pick to put in right now. I don't know who the leading candidates are, but it'll be kind of an interesting situation. But I thought the kind of the comments, though, that Jerome Powell made were interesting, especially talking about, tariffs in general. Is like tariffs are going to cause inflation. They could be stickier for longer than expected. But, he really doesn't know that. Because, again, we don't know what's actually happening with tariffs. We had tariffs, and then now we don't have tariffs for 90 days, and then the tariffs are going to be 10%, but now we're negotiating deals to remove the tariffs. So, what's he really basing his view on other than just the expectation that we might have tariffs?
Yeah, I thought that part was kind of weird. He knows that these tariffs are going to be negotiated and renegotiated, and it's already happening, and they're being paused, and this is part of the negotiating process. So Powell, it seems like, really took a firm stance against Trump. Like he was really digging into President Trump here. And I think that's where Trump's taken offense with it. The thing is, though, in theory, Trump can't fire Powell. It's more of a congressional thing. But he can fire him for cause. So what's cause? Don't know. But I think if this were to happen, it's ultimately up to the Supreme Court and how they rule it. Now, there are a couple cases, and I don't know if it's fully gone through the Supreme Court, but I want to say it's Department of Justice or one of the other departments where a higher up was fired and he can't be fired by the president. It's a very similar case. So, maybe next week I'll dig into this a little bit more, but that'll provide some precedence for what potentially could happen with Powell. But I think what's important is the Fed is huge for the markets, right? We're always talking about the Fed, and the reason we're doing it is because they have such a big influence on stock market, bond market, gold, commodities, foreign currencies, on all financial markets. And whether you like Powell or not, removing him could be problematic for confidence in those markets. And again, it depends who you would replace him with. But if you're going to replace him with someone that's just going to listen to what the president says, that could be problematic for all those markets, that if the Fed is just going to ease because the president wants to ease, that could create a fear of inflation. Especially in a time with tariffs where supply could be limited because of tariffs. You're in some weird way, if all this plays out, and it's still far from here, we're not there, and I don't want you to think we're there, but this harkens back to 2020, where we're having creating the potential for supply-related problems due to tariffs, and then at the same time you're lowering rates so quickly that you're creating demand. Again, we're not there, and I'm not saying we're going to be there, but it's something for the radar to keep an eye on.
Yeah, but not just the issue though is just because you lower rates, that doesn't create a lot of demand. 2020 was very specific because you had no production. Right, not just reduced production because of tariffs. You had no production, and you sent checks to households. So, we're not doing that, obviously. Lowering rates is something that, it could potentially help stimulate, potential mortgages, right? Maybe people run out and buy a house, but they're not going to run out and buy a house if they're already defaulting on their credit cards, which is what's happening, right? So, you can lower rates and not cause inflation. In fact, there's very little evidence that lowering rates ever causes inflation if you go back and look historically. So, it's kind of a lot of these theses that are put out, and particularly some of the comments that are made. It seems like if they would just go back and look at history a little bit, they would kind of go, well, wait a second, before I say this, every time we've been lowering rates previously, we were having disinflation, we were heading into a recession, had slow economic growth, et cetera. So, again, but there's not a lot of history with tariffs other than, early 1915s through 1930s, and we had a depression in the middle of that, which wasn't caused by tariffs. But then, of course, the only other time we've had tariffs is now, President Trump's first term, which inflation fell and economic growth grew, which certainly kind of bolsters his point that tariffs are good for the economy. So we'll have to see how this plays out.
And to your point, from 2010 to 17, 18, whenever the Fed started raising rates, we had zero Fed funds rate, extremely low mortgage rates, treasury rates, corporate borrowing rates. And the Fed was constantly complaining because inflation wasn't high enough.
Right.
It was below their 2% target.
Exactly.
So there are vast differences, but there's a narrative that could start floating around. And that's it's always the narrative that's worse than the actual story.
Well, and
or more impactful.
Right. And that was my point earlier. And this is, and this is the problem with narratives. What's driving the stock market right now? Well, it's tariffs are causing stock prices to go down. Well, if stock prices go up and we have tariffs, then what's the narrative going to be? Tariffs are causing stock prices to go up? This is the problem with narratives. We always have to assign a reason to why something is doing something. Sometimes it's just speculation in the markets, and sometimes it's just buyers and sellers netting themselves out. Sometimes there's not a narrative to it, but we always have to assign a narrative and try to create a thesis around why things should or could happen. But again, that narrative is very dangerous ultimately to investors because that narrative is going to change as soon as whatever's going on in the market changes. So we'll have to just deal with that as it goes. Just be careful with narratives. That's the whole point. All right, come back. We'll pick up. So one of the other things that are going on, I do want to touch on UNH here real quick. It's going to be one of the big drags on the Dow today. They announced earnings. Bad. Is this the start of a trend for healthcare? Is there something going on in the healthcare sector that is going to be weighing on healthcare as that group? Because it's a large chunk of the S&P, or is this just something kind of company specific? We'll come back, pick up, talk a little bit about markets in general, sectors, outlooks, those type of things. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
By the way, have you seen 1923 yet?
Yes.
I have a major beef with 1923
Uh-oh.
on
Okay.
multiple levels.
The Real Investment Show podcast.
The stuff that was happening in that show would not happen to normal people, ever.
We were watching that too, Shauna and my wife. This is so exaggerated. There's no way that this would happen in real life. This Taylor Sheridan, boy, he exaggerates it. I'm just like, just watch it for what it's worth.
Very entertaining. Just at the end of it, I was very frustrated at the end of it. I was like, after all they went through, can they just be together?
Yeah.
At realinvestmentadvice.com.
I digress. Credit spreads, though. But this is the issue with credit spreads, right? It's the 1923 version of credit spreads, which is we got to make it so dramatic.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So we're going to talk a little bit about the markets in general, just kind of what's been going on, because there's some interesting dynamics that are happening. And also feeds into the whole potential inflation story as well. Kind of digs into some of the background of the market. Healthcare, of course. And again, when you look at the market, right? When we talk about the S&P, you have to remember that the S&P is market cap weighted. So stocks with larger market caps, they make up a bigger percentage of the S&P 500 than smaller companies. So for instance, we talk a lot about the Mag 7 because they have a very big weight in the index because they're very large mega cap companies, trillions of dollars, $1 trillion, $2 trillion, $3 trillion. The Dow is price weighted. So the bigger the price of the stock in the index, the bigger weight it has in the index. So again, just two different methods of looking at things. And so this morning, the Dow is going to be down about 575 points. Wow! But the S&P, Nasdaq's going to be up 137, and the S&P is going to be up about 30. Right? So why the big divergence? It's UNH. UNH announced this morning they had earnings coming out, and again, I'm going to show you a chart of UNH here in just a second. But UnitedHealthCare, you can leave your chart up real quick. I mean, you can leave your positioning. Don't change your positioning. I'm going to come back to it. I just need the article. UnitedHealth Group grew to serve more people, more comprehensively, but did not perform up to expectations. The healthcare company also cited unanticipated changes in member profiles at its health business that cut into planned 2025 reimbursements. And they also said there was a surge in Medicare costs. Now, over the last few years, there's two things that are going on in healthcare that have been weighing on companies like CVS, Walgreens, others, which has been Medicare, Medicaid. As more and more people get older, they start tapping into more medical services, and that, those reimbursements got these insurance companies like CVS, which owns Aetna, they have to make those reimbursements, right? So as with any insurance pool, I have so much money set aside to meet what I expect are going to be the planned reimbursements for a given year, and then I can invest the difference and do other stuff. But if all of a sudden I have a big surge in claims, then that's going to impact my earnings. And that's what we've seen happen with Aetna. Over the last couple of years, there's been more and more people that are going out. They're going out to get services, taken care of, take care of their health, et cetera, but they're having more impacts from illness or age-related illnesses or age-related diseases, and they're having to get those taken care of. And that's been exceeding what the actuarial type tables were expecting, and that's been weighing on earnings for these companies, and that's what impacted UNH today. Now, Brent, you can bring me up a chart of UNH. This is a chart of UNH this morning, and this is why the Dow is going to be down 575 points. UNH is down 20% pre-market right now on this news. So they missed earnings by $2 billion. It was pretty much just a miss all across the board. So when you look at the bifurcation in the market today, it's not tariffs, right? This is UNH basically weighing on the markets. Again, because you just look at the S&P and it tells you there's something going on. UNH is also in the S&P, right? But in the market cap weighted, value of the S&P, the market cap of UNH is only $428 billion, right? So it's not small. It's not a small company, but it's not $2 trillion like an Apple or $3 trillion, Microsoft, et cetera. So it doesn't have that 20% decline. And also it's 500 stocks versus 30. So that 20% decline in UNH doesn't really have a big impact on the S&P. So that's why you're going to see a big diversification. But Mike, this does bring up kind of some interesting questions because, we've seen markets rotating very rapidly this year. Some days it'll be the Mag 7. The next day it's all value stocks, healthcare and staples. And then the next day it's over to financials. And then it's been a very rapid rotation process in the markets. And, when you take a look at the breakdown, and I was talking about, market caps, when you take a look at the kind of the biggest companies in the index, there's this kind of skews the weighting of the index to a degree. And this is how, and let me bring up a heat map here. But this is just a heat map of the market that's, weighted by market capitalization. So, when you look at the heat map, you see immediately Google, Meta, NVIDIA, Apple, Amazon, Tesla, JP Morgan, Berkshire Hathaway, Walmart, Costco. Those are your big market cap companies that are, in the S&P 500. So when those companies are moving, they have a real impact on the overall index. But Mike, we've seen this rotation that's been very rapid this year among different sectors. And then when you look at sectors and the way they're weighted, S&P, the technology sector makes up 20% of the S&P. Healthcare is a very large percentage of the S&P. Finance is a very big weighting in the S&P. Industrials and materials and energy, they're 2, 3, 4% of the S&P. They're very small relative. But, that's been one of the things that's really been kind of hard to navigate this year has been this rapid rotation between sectors within the index.
Right. I mean, I think we've done a decent job this year. We've been diversified. We haven't leaned on any one sector, one narrative, one industry too much. And what we found is that we tend to have as much upside as the market, but limit our downside because we always have, on some of these big down days, there have always been a few stocks that have actually done well. Yesterday, our energy stocks did really well in a down market.
Which we just added recently, by the way.
Right. Nice call. And you wanted to add UNH, and I said, no, let's just stick
I did
with
not
energy.
want to add UNH.
We've learned our lesson with UNH and haven't owned it for quite a while.
Yeah.
But it was an odd morning, because the first thing I do is I look at that heat map and the futures page, and the futures just tells you where every market is. And when I looked at that, I saw the Dow bright red, and the other S&P and NASDAQ were green. I'm like, what is going on? What kind of tariff do we now have? Like, how is it pointed to some industry?
Trump put a tariff on the Dow.
It almost felt like that, right? So then I go to the heat map of the individual companies, and you see the bright green for Lilly and the bright red for UNH. I'm like, could it be a tariff that he's going to tariff UNH and give the money to Lilly? I don't know what's going on. Then you read it, and there are two distinct things going on. Lilly has now the GLP in pill form that passed phase 3, so it's all but approved. Lance, did you know that only about a quarter of drugs get to phase 3 and pass phase 3?
That's correct. It's a very small percentage.
Yeah, I mean, and that's assuming you've passed phase 1 and 2 already.
Right.
So when, the market was not expecting it because the odds are just against them. But it's a big deal taking a pill versus taking a shot. And I think a lot more people will be willing to do it because of that.
Yep.
So not only is it mean more people will take GLPs, but more people will take Eli Lilly GLPs. So it's huge for them. And then it's not just UNH, but CVS and some of the other insurers are getting hit as well. And Lance, I'd have to go back and look, but my guess is UNH held up better than most companies over the last 2 months.
It did.
Till today, of course, because it's hard to tariff them, or the impacts of tariff are not as clear as like a Ford or an NVIDIA or most other companies. So, unfortunately, UNH shareholders are having their day of reckoning.
Yeah. And again, this goes back to the fact, too, that, we do have an issue with Medicare and Medicaid. We have a lot of seniors that are on Medicare and Medicaid, but we were also extending those Medicare and Medicaid benefits to a whole variety of other people. And when you start giving Medicare and Medicaid out to people that, are under the age of, retirement, those type of things, and you start putting, and this is the problem with all insurance, right? This is the problem with the Affordable Care Act. It's the problem with, and this is why health insurance has gone up so much, because we put people with pre-existing conditions into the same pool as people with no pre-existing conditions. And, that upends the entire insurance pool system, the way that it works, and creates a ton of liability for insurance companies, and which drives up cost. And and we're seeing the same thing here, is that we gave out, we kept extending Medicare, Medicaid benefits to people that were outside of the normal Medicare, Medicaid group, and we put more and more people into that pool, which means when you do that, you get more and more claims, which weighs on these insurance companies, which is why they're struggling, as they are.
That's a great point, Lance. For people that are in the insurers, the health insurers, and kind of that whole arm of the business, there's different types of health insurers, or prescription managers, that type of thing. The risk is not necessarily tariffs. The risk is that Trump's going to eventually get around to cutting Medicare, or trying to. We'll see what he can do. But there are going to be cuts. There are going to be limits. And that could, unlike tariffs, that could weigh very heavily on that sector. So there are risks out there. It's just not their turn yet. We're focused on tariffs now. But
exactly.
Keep that in mind for the future.
When we come back, we'll talk a little bit more about sector rotation in the markets. We'll kind of go through some stuff on SimpleVisor real quick and show you why we bought energy a few days ago, and why it's maybe about time to start looking at buying maybe technology again. We'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So we're just talking about a little bit about sector rotation, things that are going on within the markets. Again, lots of action today in healthcare, with UnitedHealthCare certainly weighing on the Dow this morning. And this has always been one of my problems with the Dow and why we don't pay much. People ask me sometimes, like, why don't you pay more attention to the Dow? Because the Dow used to be the Dow Jones Industrial Average, and it was all industrial stocks. And I could take that index and I could compare that to the Dow Jones Utility Index or the Dow Jones Transportation Index, and I could do economic analysis based on those indexes because you had industrials, you had transportation, you had utilities. So I told you everything that was going on economically. Now the Dow, over the last couple of decades, the Dow said, we're getting crushed by the S&P guys. So this is the group of guys at Dow Jones. We're getting crushed by the S&P guys. We need to get in the game here because those old industrial stocks are not participating with the tech stocks. And so they started adding tech stocks and banks and everything else into the index. So they tried to replicate the Dow Jones Industrial Average into the S&P, but because of the price weighting, because of the limited holdings of 30, it's not a really good proxy for the markets or the economy in general. So it's kind of lost a lot of its use, I should say, and which is why we don't pay much attention to it anymore. And we focus more on the S&P, which is a broader measure of the overall economy. Has its issues as well, right? Don't think that the S&P doesn't have issues, because it does because of its weighting. But it's a broader representation of what's actually happening in the economy. But this is why, like on SimpleVisor, we look at sector rotation, and we look at relative performance of sectors relative to the markets. And here's a piece of analysis from SimpleVisor that we use on a regular basis. I need the actual table next to that, Brent. You can just put the whole thing up for me if you want. Just put the whole page up. But when we start looking for opportunities, and this is why we added energy a few days ago, is that energy had gotten really, really beaten up. And this is the basic premise of investing, right? Which we all know this inherently, right? But we don't do it, right? We chase what's ever going up, and then we don't want to own whatever's going down. But inherently, we want, as investors, we should sell what everybody wants to buy. Thank you. And we should be buying what everybody wants to sell, right? That's, in thesis, that's how investing should work and should work the best. So the whole premise is to look for opportunities in markets where things have gotten deeply out of balance relative to where they should be trading historically. And so one of the reasons that we bought energy either last week or earlier this week, was because oil prices were extremely oversold and the sector was grossly out of favor. And, you can see at the top of the list right now that transportation, technology, energy, consumer discretionary, those are all trading at a discount relative to the S&P. Staples, utilities, industrials are trading at premiums relative to the S&P. So we should be thinking about in our portfolios going, okay, what is it that everybody's buying right now? Just, what's dominating headlines at the moment? What's deviated from long-term means to extremes? Start thinking about selling that and start finding stuff that has had a reversion and is now trading cheaply relative to the overall market. Forget all the narratives, right? As we talked about before, narratives are just excuses. At the end of the day, everything has a mean reversion to it because it's just the way prices work. It's how trading works. It's how investing works. So when things are trading well above means, you're going to have a mean reversion. And it doesn't matter what the asset is. Stocks, bonds, you name it, everything does a mean reversion at some point or the other. And you're going to get a mean reversion in assets that are grossly overbought, and you're getting a mean reversion in assets that are grossly oversold. So looking at this analysis, we're starting to look for those opportunities that are deviating well below means and giving us a better opportunity to buy things cheaper. Mike?
And, the other thing with energy is the price of crude oil got very oversold there. It was sitting on major support in the low 60s. It just broke down, went down about $10. So it's not just the oil company, the energy companies were very oversold, but the product itself, the commodity that drives their earnings, was also very oversold. The other one that I'm very tempted to buy, Lance, but I just keep a zipper on my mouth is transportation.
Yep.
That sector has been the most oversold. He had it sorted there, most oversold to most overbought. They were the most oversold. They have been the most oversold. It's been going on, 3 months now?
Yep.
But when you kind of dig into some of the companies, I can't get too excited. It's the car rental companies, the ride sharing like Uber and Lyft, the kind of true transportation companies, the shippers. And if the economy is going to slow and if tariffs are going to hamper some of the trade and travel, it's too hard to kind of get a handle on that at this point. Not to say that if you were to buy transports and kind of just put it away for 6 months, it'll probably be a good relative trade. And right. Lance, that's an important thing to know. We're talking about relative. So Lance isn't saying that he thinks energy stocks are going to go to the moon. He's just saying that he thinks they're going to do much better in the S&P 500 and most of the other stocks. So this is a relative analysis we're looking at, and transportations have just been relatively awful for a long time. And just real quick, Mike, just because I want to make sure we can get this in. So when you're at SimpleVisor and when you're looking at those relative sectors, we have a button that you can click for each sector. And if I click on that button for transports, it actually shows you the top 10 holdings of that sector. And so you can sort these. And to Mike's point, it's RXO, Lyft, Norfolk Southern, Southwest Airlines, Expeditors International, Kirby, SkyWest. It's aircrafts, it's basically airlines, car rental companies, and shippers, which in a slowing economic environment, those are the areas you would expect to see hurt the most. And that's kind of what we've been seeing over the last couple of months, Mike. And look, as you have up there, Uber is actually very overbought. So it doesn't mean every company in there is oversold, but the sector ETF itself is. And that's where you have a screen like that that's very helpful if you want to pick stocks. You can find the ones that are most oversold within the most oversold sector, or you could try to play it safe and buy one of the ones that's more overbought. But that analysis really allows us to get a handle on these rotations and not rely on narratives on which stocks and which sectors are doing better than others, because a lot of times that's not really the truth.
Right. And again, this is why, we try to do, the analysis, and we put all this analysis up on SimpleVisor so you have access to it as well. But these are the same tools that we're using to look for opportunities in the markets and, keep our portfolio in kind of a position to where we're capitalizing on these rotations. Because again, as I was saying earlier, and this has been one of the challenges, for managing a portfolio kind of through all this volatility, is that it's not one sector driving the market. It's one sector today and another sector tomorrow. So if you don't have exposure to different sectors, you're not catching this really rapid rotation that we're having running through the markets kind of on a daily basis. And again, we're starting to see more and more indications that there are cracks in the financial structure of the market itself. Again, technically we've got negative crossovers. We've got more and more sectors and markets that are trading on negative crossovers themselves. Those certainly portend to weaker markets, and that's where we're at right now. And something that we talked about very early this year, saying expect a year where returns are going to be very low, and you're going to have a lot more volatility. Welcome to the party. Here we are. But this will pass. And when it passes, we want to make sure that we're in a good position to take advantage of it. Is it passing today? No. But we're in those ranges. And this is why one of the tables that we publish at SimpleVisor is the risk range report. Brent, can you bring this up for me? And it goes through every sector and market, bonds, precious metals, international markets, small cap, mid cap, large cap sectors, and measures deviations from long-term trends. It measures relative crossovers to bearish categories. And again, as you can see, it's like we have a lot of markets and sectors that are in bearish categories. And this is definitely something you see during corrective phases of the markets, and something we'll pay attention to. What you're looking for next is to start seeing those red bearish crossovers start to turn back into green bullish crossovers. And when you start to see those changes, when you start to see that relative change in the markets, and you're starting to see more and more individual sectors, and it'll be very subtle at first. The market's not really going anywhere, but all of a sudden you start seeing more and more of these sectors turn back onto green, then that's going to tell you that markets are bottoming, and you're beginning. And this is the same analysis that we used back in 2022 to start buying the bottom of the market in October, November, December of 2022, was because we started seeing, even though the market was under a lot of pressure, we started seeing these turns in the markets becoming more bullish. And that was telling us that there's money flows coming back into the markets, there's increased buying of equities, and that gave you a better opportunity to enter the markets. Mike?
Yeah, those tools are powerful. In fact, in about a half hour, we're going to get on a phone call, portfolio management team, including Lance and myself, and all of our advisors. And we use SimpleVisor almost every day on those calls to show what we're seeing, to show what's coming in and out of favor, to help us drive, to help us steer the portfolios to create our buys and sells. So there's some incredibly powerful research in there, and it's worth just checking out.
All right, that wraps up the show for the day. We'll be back Monday. Markets close tomorrow for Good Friday, so enjoy your Easter weekend. Have a great holiday with your family. Enjoy your long weekend. And we'll be back here on Monday to pick up with whatever happens over the weekend. I'm sure there'll be something, and we'll talk about it on Monday. See you then.